Hey everybody, happy Friday. Welcome back to the final hour. It is just after 3 o'clock on December 6th. We are staring at a pretty quiet market. After the initial uptick from non-farm payroll, which was, after the news, this is opening bell. We ripped up here in the Qs. We've been sideways. We had another high right around 1:20 p.m. Eastern time. We're just kind of stalling at these tops. Here's the SPY. Had a rip to the upside, stalled for about an hour, came right back down, tested the low, very close to filling the gap today. Chart alarm set at 6:05. That's where I had a pin price on the butterfly spread. I do need this to get below probably, 606.70 is break even or better. When it comes down to closing bell, 606.50 makes money. 606 is pretty decent. That's still a 150 to 200% gain, but we need to see price actually break below the close of yesterday, break below the lows of yesterday, and doing that in the next 52 minutes is probably not going to happen. So I did take a small loss on my SPY trade today. My trade, that was an 11-cent debit. I closed out for 10-cent credit, took a small loss on that one. Actually, no, I take that back. 11 cents closed out for 9 cents, and then I closed out a 26-cent debit for 10 cents. So all I mean is I took two small losses on them. But if I look at them right now, my 10-cent credit that I closed it out for is still trading for the same price. My 9 cents right now is trading for 1 cent. So in essence, if I did nothing until now, I'd be down 9 cents different than what I was earlier today. So that per contract did save me a few bucks. And, I'm still 9 for 12 on the week with winners on my double up alert service. We were, I think, 3 for 3 or 4 for 4 in waterfall income, 4 for 5 with daily profit play. So just stacking up some trades this week. 4 for 5 winners on daily profit play and net positive there for the week, which is always a nice thing. And then 4 for 4 winners on waterfall income, which pushes that track record now to 32 for 32. I think that's what I have. Daily, 32 for 32. Daily profit play, 48 for 53. Double up, we're 9 for 12 because I'm going to take a small loss on SPY and Q and AMD. So 9 for 12, I'll still take it. We're right around 80% on the win rate. 75% on the win rate, pulled in a net $2.50. If it take full losses on the remaining trades, I'm still up $2.53 per contract. So if you're trading one contract, it's a few $100. You're trading 5 contracts over $1,000. Trading 10 contracts, a couple $1,000. It's good, right? I'll take it. And then the last one here is 9 for 12. 9 for 12 winners on the double up alerts. And also I had some winners. This would have been through A1 trading. So my A1 trading Pulver alerts. I was profitable in EETH. I was profitable in Coinbase. I closed that for a nice winner this week. It was I think I had a $10 debit spread, max profit $10. I think I paid like $2.50 to $3 for it. So I pulled out like $600 or $700 profit. EETH, I closed out for like 90+% of the profit. Another 10 wide credit spread, a 10 wide debit spread, a 20 wide credit spread. Closed out from some good cash on those. That was 3 winners on EETH, and then one win on Coin, which is Coinbase. So all in all, not a bad week. And prices, yes, we eked out some new all-time highs. We had some green on the day today, but ultimately we finished right where we started, essentially on the SPY, failing to go significantly higher, but still good enough to tap those highs and get some direction. So we had all-time highs here on Monday, all-time highs again by Wednesday morning with the gap higher. Also all-time highs Wednesday afternoon, all-time highs multiple times on Thursday for those taps to the upside, and then another push to the upside today for all-time highs. So the market just keeps poking those highs, not necessarily fading off those highs, but we have the last 1, 2, 3 weeks now. 1, 2, 3 weeks, you can see that the volume has really thinned out. This, as far as the range goes, that's a very quiet range. That's a very quiet range. This is what kind of holiday drifting looks like. Does this get a little bit more exciting? I think it does. I think that volatility is probably something we'll deal with over the next 1 to 2 weeks because all the major news that is happening for this month is happening in the next 2 weeks. So in case you have been living under a rock and not paying attention to the economic calendar, here's what's happening for 2 weeks. Next week, we have rate decisions. So if we have any Forex traders out there, rate decisions. And we have the RBA expecting to pause. So I'll put here expecting pause. We have the Bank of Canada expecting a cut, and that's a big one. That's 25 basis points. My dollar CAD long position could be very nice for that. I stacked up some more positions on that today. We have the ECB expecting a cut, and we have the Swiss National Bank. I think it goes in this order as well, from early in the week to end of the week. Swiss National Bank is expecting a cut. So this is 25 basis points. The calendar shows 50 basis points here for the CAD and another 25 basis points for the euro. And then we have, on top of that, we also have US CPI and PPI data, and that's going to be a Wednesday-Thursday combo. So RBA, BOC, Swiss National Bank, ECB, US inflation data projected to go higher. Looks like the CPI print is going to be forecasted at 2.7, which is 0.3 higher than our low that we had when we had the September CPI that printed in October. That was a 2.4. That was the lowest we had seen because in November we had October. That was 2.6. Now we're projecting a 2.7. After next week, what do we have on tap after that? Then we have the Fed with the FOMC rate decision. Probability is very high right now that they're going to cut rates by 25 basis points. And then you have the BOJ immediately after. So when the Fed wraps up on Wednesday and we get closing bell Wednesday to Thursday, watch the futures market, look to see if there's crazy stuff going on in currency land, because the BOJ is coming out with something. And I just don't know if they're going to use it as like this really kind of sneaky window to do something big with policy, right? If the Fed cuts, as the market expects, here's the watch tool. See what this probability is. So, I mean, this thing is jumping all over the place, but it's higher than where we had the week earlier. We started at like 74, went up to 79, went down to 65, went up to 90, and now it's at 85. So it's crazy how sensitive this is. I'm literally checking this intraday, and we're watching these like 5 and 10% swings in probabilities. So next week's data could be enough to move this a little bit. Obviously, coming into the week of the Fed on December 18th, this tool has never been wrong the day of since 2009. So it's a pretty good track record, 15 years plus. Every single FOMC, it's always been the proper probability going into FOMC day. So if you want that kind of today tomorrow's news today type thing, or you want to be a little bit of a forecaster, you can see that going into the rate decision, this tool has been pretty accurate for 15 years. Okay, when is the JPY rate increase due? I don't think it is due. If their inflation data is trending lower and they're trying to get to 2%, we can go by inflation by country. Look, truthfully, I think that let me go inflation by country. I think the Bank of Japan, they realized very quickly in August that they could break something. And, with the leveraging and the carry trade and everything that's, all the layers of layers on that carry trade and some peripheral of like the banking system, if they want to be the only central bank that is raising rates in a landscape where every other central bank is cutting rates, we could have another ugly volatility event like we had late July, early August. So I'm look. I don't know the Bank of Japan. I just know that their currency drives me crazy, and I just don't want to be stuck on the wrong side of something or have like an outlier type move that nobody's planning for, and I'm just not going to trade it. I mean, if something wild and crazy happens, I'll talk about it. I'll comment on it. I'm not going to have really any exposure that would hurt me on the Japanese yen. So the only thing I would say they would be interested in raising rates for would be if inflation is going higher. And if we look at Japan, this is inflation by country. Let me go G20 here. G20 Japan, we're at what's this? I'm trying to so last and previous. So last was 2.3, previous before that was 2.5. So they are trending lower. I don't know if the trend is good enough for them to just stay the course and hold rates at 25 basis points, or if they're going to say we need to raise to 0.5% or raise to 1% ultimately. And I mean, the market's going to price that stuff in. If the market catches a whiff of Bank Japan's monetary policy still getting more hawkish and still raising rates, then they'll price it in. And we'll probably see another big move on the Japanese yen. But what are the consequences for that happening compared to the dollar, compared to other currencies? I don't know. Does that break the equities market? Does that hurt the Nikkei 225? I don't know. So I think right now it's like they're probably just going to keep their mouth shut. They went off from negative policy for the first time in a decade. They're now at 0.25% by having 2 rate hikes. They're the only central bank hiking rates in this landscape. We're talking about 6 central bank rate decisions in the next 2 weeks. And 5 of those central banks, well, if RBA pauses, 4 of those central banks are cutting. RBA at 4.35, they have been pausing. The RBNZ has cut rates already. Bank of England has cut rates. Like every central bank is cutting rates except for the BOJ. Okay. So Philip saying, what happens to the market if they cut interest rates by 25 basis points instead in America? Nothing. It's already I mean, the market's been expecting that. I think that's why we're actually melting up higher, is because this probability continues to grow. I think the reason we're continuing to see all-time highs again and again and again, this is now like 56 or 57 for the year. The reason we're seeing these all-time highs is because the market is still able to justify drifting higher. The Fed is cutting rates. The market's all excited for deregulation and more capitalistic friendly programs and tax break going into 2025. There's a bit of a honeymoon phase that'll probably come in for the first 3 to 6 months under Trump in 2025. But I do think that our valuations for the S&P are historically very high. And, I don't think the markets can be dragged down forever by large cap tech. I think the Mag 7s have been great. The AI trade was a nice story. Bitcoin's been a really nice rotation. But I think in 2025, we might have this great bull market we've seen since Q4 2022, pretty much all of 2023, most of 2024, with the exception of that vol event late July, early August. If it wasn't for that hiccup, 2024 has been a pretty smooth ride. So that's 2 bull market years. We go into 2025. I think gravity takes hold a little bit. Now, we might have a correction. We might have just a pause or a pullback. We might have some choppiness. We might have something bad happen. We might have an outlier that nobody's talking about. But everyone thinking recession and bear market and like everyone believing that the sky is falling, it hasn't happened yet. And that's where black swan events occur. Like everyone thinks all this bad stuff's going to happen. So the reality is it doesn't. And then when everyone's complacent, and that's why the saying is bulls and bears make money and pigs get slaughtered. Because if we're super, super greedy and complacent, thinking this market is just going to go up to infinity where everything is going up, I get a little bit skeptical. I start to get a little uneasy with I think the risk is certainly more to the downside, and it comes in all shapes and sizes. We can have nasty, ugly capitulation type moves out of nowhere. We can have a nice, steady correction with multiple waves. We can just go sideways and do nothing. We can have another year like 2017 where it just felt like the weirdest, eeriest bull market where it really didn't go up a ton. It was like creeping up towards like high teens and 20+%, but it did every month with like this tiny little gain, and it did 12 months bullish in a row. It's never happened before in the market. And then 2018 was a volatility event that rattled everything. So a lot of stuff can happen. But what do I think happens with the Fed? If they cut rates by 25 basis points, the market's already expecting it. So I think that's why we keep seeing these slightly higher highs. Earnings season is essentially wrapping up. Mag 7's kind of leading the way right now. More order flows coming into them. And if that's enough to sustain it and drag it based on large cap and market cap, if it's able to drag it higher, then we continue to see the drift and the positive melt up, and don't fight it. And as long as the Fed isn't disrupting that, I think we finish at all-time highs yet again for the rest of the year. It may not be like 5% higher, but it might be 1 to 2% higher. It might be think about this. Let's look at the all-time highs for this week. Let's go this week and see how much higher did this market actually go. Okay, so since the election, this is the election move, right? So we had our election breakout. That was a big rip, one of the best months that the S&P has ever had in November. And then we had our pullback, and then it just starts eking out. Like as soon as we got post-election highs, I just want to show you okay, we took out this high right here by a whopping 0.1%. Okay, and then we broke that high by what? Let's see how much we broke that high by. Well, we broke that high by a whopping 0.07%. Okay, and then we broke that all-time high by a little bit of a melt up there, 0.36%. I mean, you add up those numbers, we're talking about all these new all-time highs that are failing to push the market 1% higher. You know, like I've had 3 all-time highs that have measured out to a total of around 0.5% higher. Okay, so let's go to the next all-time high. This all-time high on Monday gets broken again on Tuesday, and it goes up 0.1% higher. You know, so it's like we're making these little tiny baby steps higher, and so it's just in orbit. You know, I mean, sure, there's flows, sure, there's some momentum, but I don't think that the big buying spree is happening at these prices. I think the big buying spree was right here through the election, and it's just now set in motion, right? I mean, if we're talking about congratulations, S&P, you made an all-time high today, 0.1% higher. I mean, I'm not trying to downplay an all-time high, but it's not that exciting when it's like, yep, we just poke the highs and just kind of hang out. Poke the highs and just kind of hang out. And eventually, yeah, it adds up a little bit. But anyway, we had a pretty decent move this week on Tuesday to Wednesday. So Tuesday to Wednesday, we gapped higher and about moved 0.35%. And by the end of Wednesday, we were up about 0.5 or 0.6. That was a pretty substantial run from a Tuesday all-time high. We were about 0.5 to 0.6% higher. That's where most of this week's gains came from. A gap up on Tuesday to Wednesday and a melt up late on Wednesday afternoon. You can see here, I mean, it's getting really small, but my Thursday to Friday, again, we're right back in that tiny little, slightly higher all-time high by 0.08%. Little bitty baby steps. But there's no price action that is taking away the gains, right? There's nothing that suggests this. There's nothing that suggests a break of the structure. And so if we just keep eking out these little gains, we just stay the course. You know, I'm going to have some downside protection just to be safe. In fact, let me look at something. I don't know if this is the best time to do it or if it's something I should just put on by the end of the year. Let me price out a trade here. I've got about 35 minutes. I've got another webinar at the top of the hour. If anybody would like to join my webinar, there's an easy way to do it. I'm going to be live again at 4 p.m. I had a couple of these webinars all week. It's been a good service. We're 9 for 9. We're going to finish the week 9 for 12. The 3 losses are going to be very small, manageable. 2 of them are partial losses. 1 of them is a full loss. Actually, no, 2 of them are full losses. The Qs and AMD is a total like 50 cents as a loss, but we racked up like over $3 credit this week. So anyway, good stuff. But I'll send the Telegram link out in a little bit, and I'll wrap up this final hour session probably at 3:50 or so. Okay. I did also issue some new alerts on that system, or my alert service for double up profits. I issued some new trades on. Let me find the alerts here. NVIDIA, Intel, and MARA, Marathon Digital. So I've got 1, 2, 3, 4, 5 new trades running for next week, and I put those on today. All right. So what was I going to talk about? I don't remember. No, I do. I'm just kidding. Here's the SPY. Let me look at a bear put spread. So right now we're trading around 607.50. And what I want to look at is if I just bought some protection towards the end of the year, I want this to be something that is cost effective. So if I buy a put at 607, it's going to cost me $550. Now, in order to offset that, I'm going to give myself a nice big space to be right. Okay. And basically it means this. If price can't go higher by the end of the year, then there's some money to be made. Now, I would have to cover about a $3.80 move to the downside. If we had any type of move, Ford is an expiration for next week. Raj, that trade's still active, but it's out to next week. That's a 12/13 expiration. So I'm still in that one, but that's a 12/13 expiration. Yep. So that's out to next week. So we can sit on that one a little bit longer. Okay. So if I buy the 607 and I sell the 590, that gives me $17 of max credit if I'm right. Okay, so if we drop down to 590 or lower, I can get $17 of profit, but I would take away the 380 debit. So I'm going to have to risk $3.80 or $380 a contract, but my upside is $1,300. So if I do the return on capital there, so 1300, I'll just say 1320 divided by 380. So I've got a 347% return on capital if I'm right. Now, that is a just over 1% risk for me. If I risk 380, it actually might be less than that. So let's do 380. That's a 0.1% risk, 0.15% risk. So under a 0.25% risk on that trade. Now, I don't mind that trade. I don't mind that trade at all. So I keep the risk small. I give myself a nice upside. It would be a nice hedge. It's also a number that I can stomach. If my entire portfolio melts up and continues to go higher, I can just chalk this up as, okay, I sacrificed 0.15% on the gains, but I could still be up, maybe another 1.5 to 2 to 3% in the entire portfolio. And so I'll just chip away a little bit of that with that bear put spread if I take a loss. But I want to go out and say that I've got some type of protection to the downside over the next, several weeks. So I can protect through. And the reason I'm also considering this trade today, even though it's Friday and we're like, well, what about the news? And wouldn't you wait for the news? Well, right now the IV rank is so low that premium is really, really cheap, right? Like if I'm buying premium, it is better to be buying at these super low IV ranks than it is buying premium when IV is higher. So right now it's actually more conducive to buy and spend a little bit of time on it. Like I'll pay for the time. But what I'm going to do is I'm going to create this nice asymmetric potential trade. Okay. So I'm going to put this trade on. I wonder if I did like a 610. Yeah, I'm just going to take this 608 or the 607. Let's see here. If I did a 610, let me see what this is going to cost me. So 527, 517. Let me make this, I'm going to have this pay like less than, okay, so that's less than $5. This isn't bad. That's $1,000 a gain. I kind of like the other one better. I guess I'm just thinking like if the price drifts up higher, to 610, then I'm going to lose a little bit of value there. But I like to at the money. So the 608 by 590 cost me over $4. What's 423? I'll take this trade. I'm going to go 608 by 590. And this is going to be a bear put spread. So it's going to cost me 424, 425 roughly to get in the trade. I'm going to put this on for everybody. So 424 is not filling. Let me try a 425. Filled at 425. Okay, so I'm going to take this trade. Let's go down the line. Everyone's getting in on the action here. Okay. All right, so that trade is in. Let me throw this in. I'm doing a short trade right here. I'm wrong above. Basically, I'm wrong if price is above 608. So anything above 608 is my risk, but I've got downside protection all the way to 590. This is out to the end of the year, so it gives me a little bit of a reason to say, okay, I'm hedged. It's pretty inexpensive. All right, so I'm doing a 12/31 expiration. This is on the SPY. Buy the 608 put, and then sell the 590 put. So $4.25 debit for a $18 max credit. Okay, would I take max credit? Well, I'd have to wait all the way to expiration. So the answer to that is no. If I turn this very quickly into, let's say, $12, $14, $15 credit, I'll probably take the profit early. So it just depends on what price ends up doing. Okay, so I'm going to take a screenshot of this. This one's going to be an A1 trading alert. So my Pulver alerts here. I'll throw that in and just let everyone know this is for a hedge. It's a hedge position, but this is going to be an index trade. SPY 12/31 expiration. Buy the 608 put, sell the 590 put, 4.25 debit. So it's 425 max risk per contract and $1,800 max profit per contract. This is a hedge and protection play in case the combo of 6 rate decisions plus U.S. inflation news and end of year flop prevail. If there's some type of like crazy profit taking or some type of breaking news that nobody sees coming and the market decides we're taking profit and we see like a little 1, 2, 3% move to the downside, then I want to make some money on that. Okay, so pretty straightforward. Screenshots right there, posting this inside of my A1 Trading Discord for Pulver alerts, and we're good. Okay, so that trade is in. Okay. So Raj, you have it right there. If you want it, you got it right there. So 12/31 expiration, 608 put. Verify that right here in my broker account. 608 put, 590 put. I'm going to add this into my tracker as well. So here is, and again, the purpose of this trade is to hedge. So if you're like, you know what, I've been hedging and I've been losing money, the market's just going up, I'm never going to protect the downside, you don't have to take this trade. Okay. But I'm taking this as a protective measure. It's going to be a 0.15% risk to my account. And if the market melts up and I lose on this, you know, my 2 to 3% upside of the melt up is going to just eat this and I'll still make, you know, a nice net profit. So, you know, it's just a trade. Is this me calling the top? No, but it gives me, look, if you can see my screen here, the fact that we're sitting at a 4.6 IV rank in the SPY, that's about where we were in July. Okay. The middle of July, this market started to top out. And by middle July into August, this market saw like 4 to 5 IV rank jump up to like 40 or 50, 60 or 70. You know, that was a crazy volatility event. So, not saying it's going to happen again, but I would rather be a buyer right now looking for this melt up, or just, you know, credit spreads obviously staying out of the way. But point is, if I'm hedging, this is a really inexpensive way to do it. Okay, so I'll show you what that trade looks like. Just give me a second here to get this one in. So this is a 12/31 expiration. Buy the 608 put, sell the 590 put, and I paid $425 debit. And I'm going after $18 max credits. I would be happy with anything over like $14.25. If I make $1,000 per contract on that hedge, anything over that I'll be happy with. Okay. All right. So that's that. Let me build this trade out for you. This is what it's going to look like. Risk graph. Float this out here. Actually, it's funny. I talked about this trade earlier today in one of my live sessions, and I ended up taking exactly that. So it's clearly been on my brain all day, and so now I wanted to actually take it because I see that the IV rank is so low that I'm like, I'm just going to take a stab at it. You know, so what do I need for this trade to be profitable? Well, this is live price right now. That dotted line is 607.62. If we go down to basically 604, okay, or 603, we're going to be break even or better. So if we move to 600, we're probably going to see roughly an $8 credit. Well, we can make, if I make 100% gain on this trade, I'm okay with that, right? If we go another chunk and we've got $12 of credit, okay, cool. I'll make 200% gain on this trade. If we go, you know, to my max profit here would be $18. So where do we need to see price go? If we're below 590, if we're 590 or lower, then we have an opportunity for max profit. Okay, but the reality is my max profit of $18 is at expiration. So if we have something violent happen, more than likely, I'm going to see some real premium here, but I'm not going to get my full $18 up front. So if we have a very quick move down to, let's say, 595, we could probably see like an $8 or $10 credit. I might just take the profit. You know, it just depends. So we'll see if it serves the purpose. We got rate decisions next week. We got the Fed after that. That's a nice little 2-week window of like, I think we should be mindful of the downside just in case something silly happens. But the nice thing is this is my low risk and my way higher potential reward. And this is a hedge. So if I win on the hedge, it pays a lot more to the profit side than it does on the risk side. And this is roughly a 0.2% risk. So it's very, very small, But if let's say I make full profit here. If I make full profit, this is close to a 1% gain. A 1% gain for my entire account. Not just on the position. It's like a 350% gain on the position. But for my entire account, I can basically have a 1% hedge that only cost me about 0.2%. So it's not too bad. All right. All right. So that's what it looks like. That's the trade that I'm in. We still have 20 minutes before the close. Papa John, I'm sorry to say that I don't think the 605 is going to get hit, my friend. That 605 is probably my 11-cent debit right now is showing. Let's see, that's the 610. Right now, that trade is a penny or zero. It's essentially worthless. So I would have lost the full 11 cents in that trade. The initial one that I took for 26 cents, right now that's trading for 7 cents. So, I mean, net, I saved myself about 12 cents on the total risk, which is fine. I'm going to eat a little 20-cent loss on the Qs today. The Qs are not coming down to 520, so it's fine. And like I said, net on my double up alerts, we're up $2.53, even at close today. That's a successful week for, one contract, for 5 contracts, 10 contracts. That's a great week. And we got plenty more trades to come. No, yeah, you're right. So, but what'd you do today? I saw you had a good day in daily profit play, right? You had a good week in daily profit play. So I think you're fine. All right, VIX. Let me go SPY here. The VIX is going slightly lower. So here is the VIX. Where are you? The VIX at 1295. This is another thing I want to keep a close eye on as we go into the end of this year or into 2025. I would not mind looking at a, let's say 30. Let me change the color here. A 30 to 90 day long vol play. 30 to 90 days. Okay, now what would I do to trade that? I would either just put on a credit spread and just let it be time-based, or I would do an out-of-the-money call and try to take it very, very inexpensively and see if I have a big enough time window that, maybe it costs me, I don't know, $3 to take a debit, but if it goes up in a short amount of time and goes up quickly, then maybe I can turn that $3 into, a $6 credit. Again, wouldn't cost me a lot for something to make 100% return on risk. So I don't know. I obviously want to make more than that. I wish there was a little bit more asymmetry when I trade the VIX, but there's really not. So perhaps I do like a 0.5% hedge down here with a credit spread, and I'll just say I don't think it can go lower. Maybe it can, maybe it can't. It just depends on the premiums. If I did let me take a look at the VIX right now. Okay. INTC. You just put in INTC at close for profit. How'd that happen? I did 2 trades on INTC. They're 2 long puts. I did a $20.50 and a $20 long put. I'm still on that trade for next Friday. Yeah, make sure it's a 12/13 expiration on that one. Okay. All right. What was I? Oh, the VIX. I was going to go to the VIX. Here's the VIX. So let's go VIX. And if I went out, I hate the fact that we have AM expirations, but it's fine. If I went out to March or April, let's see, March 18th or April, I kind of hate this trade, but right now when at the money is trading for about $5, if I move out of the money, 335, could we get a move on the VIX back up to 16? I mean, obviously, yes. So that move to $17 would give me some intrinsic value. I'd obviously need to see some time premium still stuck in that trade. And this is a tough one. Let me see what a credit spread trades for. If I do a 13 by 12.50, you just don't get the premium. I mean, I'm risking 38 cents to make 12 cents, and I'm trading 11 cents above the at the money. So if this was more of like, okay, I can risk 25 cents and make 25 cents, I'd be willing to take that trade. Now I've got to go in the money to do it. I mean, that's even crap. I risked $35 to make $15 and I'm, 70 cents in the money. So I just think the VIX is hard to trade on a credit spreads perspective because the premiums are so bad. Maybe the flip side is if I buy this. Nope, because I risk $38 to make 12. It's still just a crappy instrument. 32 cents to make 18. Nope. So I don't know. The only play I see if I'm going to do the VIX or the VXX would be I've got to just do an out of the money call. There's other ways to trade. I'd rather trade the indexes. I'd rather hedge on futures. There's so many better ways to hedge the market than trading the VIX. So I'll just wait. Anyway, that's all. So no trade in the VIX. Currency strength on the day. We had an interesting kind of risk off day. We see the dollar yen on top. We see the Swiss on top. We see the pound, the euro, the CAD, the Aussie, the New Zealand are the weakest. So we kind of see some safe haven flows up here, even though we did eke out an all-time high again on the NASDAQ and the S&P. So interesting order flows. Dollar again getting stronger. I'd mentioned to traders all week, if you're in any of my live sessions, we talked about the dollar index. I said watch that 4-hour 200 moving average. And today's non-farm payroll just came right to it and bounced right off of it. So I don't think the dollar's necessarily going lower as of right now. And believe me, Trump is a president that wants a weaker dollar. He's going to want to see the Fed cut rates like crazy. He's going to want to see a weaker dollar. I think during his presidency, when we had 2016 to 2020, 2016 to 2020, this would have been, where were we? 2016 going into the election year. Okay. So the election was in 2016. So he was president starting in 2017. Look at how this thing basically topped out. December 2016, January 2017, Trump is president. From his presidency for over a year, the dollar just got absolutely smoked. Now, does that happen again? I have no idea. But it's kind of interesting how we have this huge run to the downside and then a rebalancing. We've got the COVID shakeout right here. And then, even with Biden stepping in to the new presidency in 2020, COVID happened February to March, lots of crazy price action, came right to the same highs, came right back to the same lows. Just a big range trade on the dollar. So anyway, I don't know. I'm just curious, like, does this go to the same highs and then go back down into a range? Does this go to these same highs here and then go into a range? I would imagine that Trump does not want to see a super strong dollar. Right now it's kind of led by confidence. It's not really the presidency that started to push the dollar up. It was the U.S. economy is really carrying the global economy. I think I said this week, but total market cap of the global economy is 63% U.S. based. That's how large the U.S. is. Money supply of the world is like 40% China, 40% U.S., and then the rest of the world. Like Japan's in there somewhere, but it's like, between money supply, global liquidity, and total market cap, the U.S. has been carrying the torch for the entire global economy for 2 years. That's where the big opportunity is, like, oh, these emerging markets, this non-U.S. play could be a good one. It could be, but it could also be just garbage because they've been garbage for 2 years. And it might just be that the U.S. slows down. So it will all, we'll have to see what takes time to play out. Either the U.S. slows and the global economy slows, or the U.S. like flinches and blinks and does something stupid and then it breaks something, or maybe we have some contagion that's starting to crack and fracture elsewhere. I don't hear great things about the Eurozone right now. We know Japan's a big wild card. We've got geopolitical tensions all over the place. Is that enough to top the markets out? I don't know. Probably not. It's probably going to have to be something a little bit more internally damaging, like the U.S. inflation is getting out of control. Consumers are stopping to spending. Delinquencies are going up and debt structure is awful. Mortgage rates haven't budged. That's more of like the slow drip to kind of break the economy. Something more abrupt is, kind of out. It's out there. Like nobody knows. Nobody knows what it's going to be. Okay. Gulia's question. I manage money for friends and family. I've got my capital. I've managed some accounts for some people for like 15 years. So yeah, I just trade private capital. Credit spreads on MARA, NVDA, and Intel. I have 2 puts. Yeah, Intel 2 puts. That is right. You follow alerts, Papa John, right? So NVIDIA, MARA, credit spread, NVDA, long call, Intel, 2 long puts. You got it. That's out to next week. Those are all next week's expirations. Okay. Any other thoughts? Any other questions? Any other charts you want me to review? I'll take a few more minutes. I'm going to give myself a little breather. I got a webinar coming up at 4 o'clock. If you'd like to join my Telegram channel, it is free to join. So here you go. I'll put in my Telegram link and my Discord link. So there it is. So this is Chris Pulver Trading Telegram. There we go. And here is my Discord channel. Chris Pulver Trading Discord. And I'll also make a shameless little plug for my $27 options course. bmu.com/on-demand/quick options. If you click on that link, it is a nice starter for anybody interested in a crash course on options. I have 4 videos, 6 strategies, a little PDF, and a price point that I've heard 0 people complain about. So if I could interest anybody in options, this could prepare you for trading ETF options, index options, any stock that you like, futures options, currency options, commodity options. You just got to know the process, and you can trade all sorts of asset classes. So check it out if you're interested. You can buy the whole thing for $27. If you want the full kit, you got a whole upgrade if you want it with a 72-page PDF, 13 strategies, and about 3 hours more content. So for my learners and earners out there, there you go. Okay. Let's see here. Raj, if you want to reach me, Discord's probably the best way to reach me. So if you're in my Discord channel, you can just throw it in the free group chat or post it into a respective channel. Throw it in if you're looking at a clarification on options or futures. If it's something with my alert services, you got a member portal, you got a trade tracker. Everything I'm doing is posted. So I mean, honestly, I'll just refer to that. If you're in the Pulver alerts with A1 Trading, it's all in the Discord channel there. I mean, I post everything from the underlying asset to the expiration to the exact puts and calls to the debits or credits that I'm paying or receiving. I mean, I try to make them all as detailed as possible. Oliver, SLV for a butterfly December. What are you doing there? I'm just waiting. Are you trying to pin price on SLV, and if so, where? I mean, I'm long SLV. I'm just gonna wait. You know, I mean, I started to scale in more. I own shares of SLV. I've traded SI futures. I'm still up a couple $1,000 on SI futures. Let me check here for the whole account. Let's go positions. So SI, I'm up around $4,000. I had another position close out for like $5,000 last week or the week before. Gold, I still have some GC futures up $700. So yeah, I still got some future trades running. There, you know, lots of puts and credit spreads. That is a, what is that one? 32.75. So a buy call. What? Hang on a second. Okay, so it's a bull call spread. Got it. For 25 cents. Okay. I just want to collect premium over the weekend. I'm a newbie to options. So a butterfly spread, though, that's a debit, man. Are you doing a broken wing butterfly? Are you doing an iron butterfly? Like, what are you doing? Is it a 3-leg trade or 4-leg trade? Zen, I'm asking about the dollar Swiss. I'm just holding long dollar Swiss, man. There's nothing that's going to prevent me from going long dollar Swiss. So I'm in already with a base position. I'm stacking orders to the upside. If it comes back lower, I like this cluster to look for a buy trade, and I like this cluster down here to look for a buy trade. So I am long until I get to 9,200. It's that simple for me. I will add more. I will add more if we pull back. Okay, I will add more if we go up. but my profit target is 9,200. So I'm just going to keep scaling into it. I like dollar Swiss long, especially if the Swiss is going to cut rates. That's a good thing. If the dollar is going to cut rates, so be it. There's still positive swap in the trade. Keith says, Bitcoin ETF made my day. Top growth ETF. BITU up 70%. TQQQ up 21. You love those leveraged instruments, don't you, Keith? It's good stuff, man. I mean, if you trade them short term, they work out just fine. I just don't do a lot of the short term stuff in that regard, but they work. They work. Cool. All right, I've got a little break here, 7 minutes before I start my next webinar. If you'd like to join, if you're in my Telegram channel, if you joined in, there is a link that's posted. If you can see the history on this, I'm doing a 4 p.m. Session. I think it's just going to be maybe I've got an MC with me, but I'm talking about my double up alerts. So the service is out this week. It's been a lot of fun. It's super active. I only look to trade maybe 3 times a week, 5 times a week with very high probability trades. But I'm running some really powerful scans that just spit out a lot of ideas, and then if I like the trade, I'll take a stab at it. It's very cost effective, low cost, high reward. That's the plan. Average gains this week, just so you know, I'll just read off some of these numbers. Winners this week: 70.2% return on risk, 59% return on risk, 106% return on risk. Took a fractional loss at 63%, so manageable. Winner at 79.3%, 214%, 86.6%. Small loss at 9%. So, I mean, I'm going to have a couple other losses. I'm going to take a loss on a QQQ butterfly. That'll be, it's a small debit amount, but it's going to be 100% loss, but it's very manageable. Anyway, point is, I'm looking for big wins. Cost-effective trades, small debits, high return on risk, and really, really like aggressive scans within like a 0 to 7 day environment. And it's going to be fun. It's going to be active, but you've got a solid 8-hour window to take into these trades. They're not super time sensitive or price sensitive. Depends on the situation, but they're not zero DTs. I don't like zero DTs outside of what I already do for my daily profit plays. Okay. All right. I'm going to take a small breather, and hey, it's Friday. Go out and touch some grass. Go make a snowman. Be somewhere warm. Enjoy the sun. Have a great weekend. See you next week. All right. Bye.